Okay, good day to everyone. For this video, we are going to discuss sources of short-term financing. This will be our last topic before we have our examinations. So basically, we are going to discuss here how we can finance, okay, or how we can finance our business through short-term loans or short-term debt, and we can actually use our current assets to finance our operations. So, to start with, let us introduce first the chapter outline. So, we are going to have these items as part of our chapter outline. So, basically, we are going to discuss trade credit as a means for us to have short-term financing. We're also going to discuss bank loans, commercial papers, and we will discuss how we can borrow larger amounts. This will basically talk about how we can use our assets or our current assets to borrow more funds, and we are also going to discuss hedging. Okay, hedging pertains to the process of offsetting or investing in order for us to equalize or neutralize the risk that are present in our business. Okay, so let us first discuss the concept of our financing arrangements. Okay, so basically, in every type of loan or in every type of borrowing that we are going to enter into, there is what we call our financing arrangements, and generally, this is going to talk about the interest that is related to our borrowings. Okay, so the lines of credit that we have are sometimes referred to as a revolving credit facility, where interest cost is either based on the LIBOR rate or the international rate, also known as the London Interbank Offer Rate, and it is also sometimes based on the company senior unsecured credit rating. Okay, which is basically based on, this is similar to what we discussed in the previous video, which is basically your credit rating. Okay, and the primary aim of firms who are borrowing funds is of course to minimize cost. Okay, or meaning if you are going to borrow funds or if you're going to look for sources of financing, what you are trying to look for is the best alternative, and the best alternative is going to be the borrowing or the financing alternative that will give us the lowest interest cost. Okay, so the first possible sources or the first possible source of our financing will be trade credit. Okay, so how is it that we are going to consider trade credit as a source of financing? Because basically, if you are going to buy or if you're going to purchase goods from a supplier, most of your purchases will be on account, meaning you are given a certain period of time before you are going to be required to pay. So in your basic accounting, you learned the concept of your cash discount and your due date. Okay, so basically this is where trade credit comes in. Okay, so if let's say for example your company is given 60 days before you are going to be required to pay whatever is due to your supplier, then you can actually maximize the 60 days and use that as your maximum payment period. Okay, so if your company, let's say for example, is given 30 days or 1 month before you are going to be you're going to be required, or before the account is going to be due, then you can maximize that also. Okay, so before we move on, let us just remember that approximately 40% of short-term financing is in the form of accounts payable or trade credit. Okay, so this is where we are going to maximize our borrowings, okay, or our financing. Okay, so this is where we have our accounts payable, meaning we are going to maximize the period before we pay our accounts payable. Okay, and this is actually going to be good particularly if if you are in business and you would like to maximize or to stretch your cash flows. Okay, so this is what you're going to do. Basically, you're going to maximize the credit period. Okay, so accounts payable is a spontaneous source of funds. It grows as your business grows, and it contracts as your business declines. So basically, it moves in the same pattern as as the movement of your business. So the thing here is, with trade credit, you always need to understand that yes, you can stretch your payment period. Yes, you can maximize the discount period. However, if the company now provides us with cash discount, then it is going to change our business decisions here. Okay. So, just like what we said, it is possible that the credit term or the credit period that was assigned or that was provided to you by the supplier can be within 30 to 60 days usually. Okay, it is also possible for you to extend the payment beyond the credit period. Okay, but of course this is not a good practice because number one, it will result in the alienation of suppliers. Okay, so or meaning, if you are not going to have a good relationship with your supplier, then it is possible that you cannot have a repeat transaction with them anymore. Okay, so it is best that you follow the credit period or the trade credit period and do not extend beyond that because it will result to a bad relationship with your supplier. And also, if you are not going to pay if you're not going to pay within the trade period, it is also going to result in a diminished rating in your with credit bureaus, or basically it's going to result to a bad reputation for the business, which will now lead to your business being either blacklisted or being tagged as a bad payer, okay, or a bad credit payer. Okay, so that's basically something that we need to avoid. Okay, so also we need to understand that in certain credit periods or in certain credit terms that are provided to us, businesses or our suppliers usually will provide us with a cash discount, okay, which will now then give us a different decision, okay, considering that cash discount is actually one way for us to lessen the amount that we are going to pay. Okay, so with that, we need to consider the cash discount policy and determine if we are supposed to take the cash discount or not. Okay, so basically, to have an example, let's have this. Okay, so assuming that a business gives us a 2/10 net 30 cash discount means, so a cash discount, which means that if you are going to pay within 10 days, you are going to be given a 2% discount. However, net 30 means that your due date is actually 30 days from the date of the transaction. Okay? Now, you may say, it's okay for me to avoid the 2% and not take advantage of the cash discount because anyway 2% is a small amount considering the number of days that I can stretch the payment. So instead of paying within 10 days, I am going to pay 30 days and maximize the credit period. But again, we need to consider that if we are not going to take 2% discount, there is an annualized amount or there is an annualized rate, okay, or annualized percentage that we are not taking advantage of. And for us to compute that, we are going to have this particular formula. So the formula there is discount percentage divided by 100% less the discount percentage multiplied by the quotient of 360 divided by the final due date and the discount period. So for us to understand this better, let us try to compute the annualized effect or the annual loss that we are not or that we can potentially have with foregoing a 2% discount. So let's have that with our solution. So first, let us get the first portion of the solution, which is discount percentage divided by 100% less the discount percentage. Okay, so that's going to be, so if we're going to have this formula, and we are going to follow the format. So for a while, please, I'll just change the format. Okay, so that our solution will be consistent. Okay, so let's have one more for a while, and this one last. Oops, sorry. Okay, so this is going to be multiplication. Okay, so first let's go to the discount period. Okay, sorry, that's discount percentage. Sorry, that's wrong. Discount percentage. Okay, so the discount percentage is actually 2%. Okay, and then we're going to get the difference between 100% and the discount percentage. So that's basically 100% minus 2%. So that's going to be 98%. Okay, and then we multiply it by 360, and we are going to get the difference, okay, of the final due date. So the final due date is actually, if you look into the problem, that's 30 days. That's the final due date, less the discount period, which is 10 days. Okay, so if you try to look at that, so this is going to be, I'll just merge this one. So if we compute that, 2% divided by 98%, what's wrong with the formula? Oh wait, the formula is wrong. Wait, I'll just check the formula for a while. So that's going to be, so that's going to be 2.02. Okay, I'll just change the format. And then this is going to be, wait, what's happened here? This is supposed to be 30 days less 10 days. Why is it? The format is, wait for a while, just check the format. That's 30 less 10. Okay, so anyway, if you try to compute that now, that's going to be 360 divided by 20. Okay, so our answer here now is going to be 0.02 times, that's going to be 360 divided by 20. That's going to be 18. So if we try to compute the net amount, that's going to be this one multiplied by this one, and you will get 36. If we compute that and turn that into percentage, that's actually 36%. Okay, so that's going to be 36%. So meaning, if you are going to forego of a 2% discount for 30 days, the annualized effect is actually 36%. So on an annual basis, you are not only losing 2%, but rather you are losing 36%. Okay, this is the final answer here. You are losing 36% from the failure to take a cash discount, which means that every time you are borrowing or every time you are not paying on time, you are actually losing a greater amount of money. Okay, because you are actually wasting 36% discount on an annual basis. Okay, now, it is okay for you to forego the 36% discount. That is if you can assure that as a financial manager, you can use the excess fund. Okay, you can use the excess fund that you did that, or that was extended because of the extension of the payment. Okay, you can use that to earn more than 36%. Okay, to um, to further explain is basically like this. If you are supposed to pay, just to give you an idea, if you are supposed to pay 1 million, okay, so let's say you are supposed to pay 1 million, okay, and this is already, in order for you to take advantage, you need to pay within 10 days, okay. If you're going to pay within 30 days, okay, then you're still going to pay 1 million, of course. Oh, sorry. Okay? If you pay within 10 days, there is a 2% discount, correct? So if you try to compute that, it's going to be 1 million times 2%. Okay? So you have a 20,000 discount. If you pay within 30 days, you're going to pay the total amount of 1 million. Okay? So the question there is, or the item there is, it is okay for you not to take care or not to avail of the 2% discount. That is if you can make sure that within the 20-day difference, okay, the 20-day difference, you can earn 20,000, at least 20,000 or greater. Okay, within the 20-day difference. Okay, so basically it's going to be like this. If you pay within 10 days, you are going to pay only 980,000. Correct? Okay, so that is the amount that you're going to pay. If you are going to pay within 30 days, you are going to pay 1 million. Okay, so that's actually the amount provided here. So if you are going to maximize, okay, there is a difference of 20,000 here. So just remember that it's okay for you not to avail of the cash discount for as long as within the 20 days you can earn, or you can use the 1 million to earn at least 20,000 or higher. Okay, so that is the concept there. So meaning, for every time or for every period that you are, or for every discount that you are not going to avail of, you just make sure that you can earn at least equal to or beyond. Okay, of course, the main goal is to earn beyond the foregone or the cash discount that was foregone. Okay, in order for us to make sure that it was worth it, okay, to forgo with the discount. Okay, so if let's say for example you use the 1 million, okay, so let's say 1 million here, okay, and within the 20 days you earned, let's say, 4%. Okay, so you actually earned 1 million times 4%. Let's say this is already our earnings within the 20 days. So you earn 40,000. So it's okay because you earned an additional 20,000. Okay? And you took advantage of the 20 days to earn more. Okay? So it's okay for you to forgo with the discount. But the concept there is it's not always that you can earn what you lost. Okay? Or the discount that you lost with the cash that you did not use to pay up the liability or to pay up the accounts payable. But anyway, that's just how you deal with that. Okay, so this is just one formula for you to understand the discount that you are losing on an annual basis and how you can still make sure that you are going to earn more than that. Okay, so that's basically how you are going to use the cash discount policy in your decision making. Okay. By the way, before we move on, since the annualized effect is 36%, okay, if you're going to lose 36%, make sure that on an annual basis, you are going to earn more than 36% from the funds that you are not, for the funds that you are not yet going to use because of the extension of the cash discount. So, meaning, going back, if let's say, for example, your annual cash or the cash flow or the cash that you are going to have available over the year because of the cash discount that you have forgone is 1 million, make sure that you're going to earn 36% on an annual basis for you to make sure that the discount that you did not avail of is going to be worth it. Okay, so that's basically the concept there. Okay, we now go to the net credit position. Okay, this is another technique for us to have a better financing. The concept here is to basically make sure that we are collecting faster than how we are going, or than the period in which we are paying. Okay, so this is determined by basically examining the difference between your accounts receivable and accounts payable. Okay, so you have a positive net credit position if accounts receivable is greater than accounts payable and vice versa. Okay, and meaning if your accounts receivable is, or if your accounts payable is greater than your accounts receivable, then you have a negative credit position. Larger firms tend to be net providers of trade credit, which means that they have high receivables, and smaller firms relatively have the opposite, which is user position, wherein they have higher payables as compared to their receivables. But the concept there is it's basically like this. If you are a smaller firm, what you are doing is you take advantage usually of the credit term. That's why you have a negative credit position. Okay, which means that you tend to, or you like to collect your receivables faster and then pay your payables on a longer period. That's why you have a negative credit position. Okay, for larger firms, they are going to have or they are paying their payables faster as compared to when they are, or the period wherein they are collecting their receivables. That's why they are, or they have a positive credit position. Okay, so anyway, they are the larger firm, so they can cover that better as compared to smaller firms. But the concept there is if you want to extend, or if you want to extend your credit position, or if you want to have if you want to take advantage of your credit, okay, or to have a means of financing, then you need to be, or to think like the smaller firms and pay your, or collect your receivables faster as compared to the payment of your payables. Okay, so aside from your trade credit, you can also look for bank credit. Okay, or you can look for bank loans, okay, and borrow money from banks as a means of collecting your, or as a means of financing your business. Okay, so basically this is what happens there. In bank loans, you are going to borrow money from the bank, and the proceeds will be directly credited to your bank account. Okay, so of course this means that you need to have a bank account with the same bank wherein you are trying to borrow money. So what's going to happen here is whenever there is the amortization of your loan, the bank will automatically deduct the amortization from your account balance. Okay, so that's what's going to happen there. That's why bank credits are called self-liquidating loans. Okay, because basically it will self-liquidate by simply removing or deducting the amortizations from your business or from your bank account. Okay, so the use of funds ensures a built-in or automatic repayment scheme. Okay, so just like what I said, the loan or the bank will automatically debit or automatically reduce the balance of your bank account. Okay, so with the changes in the banking sector today, okay, so these are things that we need to consider. First, centered around the concept of full service banking, which means that the bank will be the one to take care of all of the loan requirements for as long as you as the borrower satisfied all the requirements, which means that when you're going to receive later on your bank proceeds, it is already going to be net of the service charges that the bank extended. Okay, so if let's say for example you're going to borrow 1 million, do not expect that you will receive 1 million because there will be deductions for the service charges. Okay? Expanded internationally to accommodate world trade and international corporations. So, this is actually applicable not only for big firms or large firms but also for small businesses. Because generally, if let's say for example, you have your credit cards or you have your debit cards, you can actually use that for your international transactions, but then it will also be it's going to be charged to your accounts. Okay, so international business or your automations will actually allow you, even if you're a small firm, to transact internationally. Okay, the regulation has created greater competition among other financial institutions, and this is actually the reason why there is a competition with extension of credit, with the with applications for credit cards, okay, in all of those bank services, okay, because banks earn from interest. So if they extend more credit to people, then there will be, or businesses, then there will be more income on their part. Okay, so basically that is how the banking sector works, and that's why they are usually going to do their best to extend credit to businesses and firms, okay, with of course the security that these borrowers will be able to pay back the bank, okay, in the form of interest and the principal amount, of course, at the end of the credit period. Okay, so with that, we are going to discuss the concept of your prime rate and the LIBOR, because this is usually the basis of other banks or other financial institutions in lending money. Okay, so the prime rate pertains to the rate of bank charges to its most creditworthy customers, and it increases as a customer's credit risk increases. Okay, so meaning the prime rate is talking about the risk-free credit rate. Okay, so meaning if I am going to borrow money and there is no risk, okay, that the creditor will not collect from me, then prime rate can be given as the interest rate on my loan. Okay, so if let's say for example, I am going to borrow 1 million from a bank, and they consider my credit rating to be very high, that there is no risk that I am not going to repay them. So they can charge me with just the prime rate, and usually the prime rate is going to be a very low interest rate. So if let's say for example the prime rate is only 5%, then that will be the interest that I am going to pay, because the credit that was extended to me, or the loan that was extended to me, was actually risk-free. Now, if your loan, or if the loan that is extended is given to a customer that has risk involved, meaning your credit rating is not that good or your credit reputation is not that good, then expect that they cannot lend you using the prime rate. There will always be the what we call the risk premium, or the additional interest rate. So if the prime rate is 5% and your credit rating is not that good, then most probably they will charge you with 6%, 7%, 8%, 9%, 10%, depending on your credit rating. So that's why it is always good that you have a good credit rating, because that means that you can borrow money at a lower interest rate. Okay? Also, if you are not going to use the prime rate, we can actually also use the LIBOR rate, okay, or the London Interbank Offer Rate, which is internationally or worldwide or widely used, okay, in our world economy, okay, and this is the rate offered to companies that has international presence, or that has the ability to use the London Euro-Dollar market for loans. Meaning if you can borrow, okay, through this particular means, okay, or through the London Euro-Dollar market, then you can actually borrow at the LIBOR rate. Okay? Or basically the interest rate that is imposed by the London Interbank, okay, or basically the London Euro dollar market, okay. But this is only applicable for international businesses. So if you're a small firm, you can just rely on trade credit or bank loans, okay. You cannot actually have this if you do not have, or if you cannot establish yet a good credit rating or an international presence, okay. So if you look at this is actually a chart of the difference between the prime rate, okay, and the LIBOR rate, okay, on US dollar deposits. Okay, so this is the prime rate and this is the LIBOR. So usually, or if you look into the trend, the prime rate is usually going to be higher as compared to the LIBOR rate. I do not know the reason behind, okay, but basically this might be due to the international exchange differences and the market differences between the LIBOR, because basically LIBOR is for the euro dollar, or the what you call the currency that is being used in the euro countries, okay, or the European countries, as compared to the US dollar, which is going to be for the United States market, okay. So this is what's going to be the expected rate, okay, and of course it fluctuates depending on the economic condition. But generally, if you look at this, the prime rate will always be higher as compared to the LIBOR rate. And of course, the reason why you can have a lower interest rate under LIBOR is because only companies with very reputable or with a very reputable name in the economy or in the market can borrow under the LIBOR rate, or with using the LIBOR rate, okay. That's why usually this is going to be lower as compared to the normal prime rate, okay. So with that, okay, still talking about your bank loans, okay, there is the concept of our compensating balance, okay. So again, compensating balance is a bank balance that you need to maintain, okay, to compensate the loan that we had, or that the loan that was extended to us by the banks, okay. So generally, this is what's going to happen there in relation to the extension of credit, okay, by the bank to our company. The company in return needs to maintain a certain amount, or maybe a certain percentage of a loan to their bank account, okay, to compensate for the loan, okay. So that's what compensating balance is. So to explain further, a compensating balance is basically a fee charged by the bank for services rendered on an average minimum account balance, okay. So this is going to be beyond the minimum account balance that you need to maintain, okay. So when interest rates are lower, the compensating balance will increase, and of course vice versa. If the compensating balance, or if the interest rates are higher, then the compensating balance will be lower, okay. So the required balance, okay, computed on the required maintaining balance is computed based on number 1, the percentage of customer loans outstanding, and the percentage of bank commitments towards future loans to a given account, okay. So this varies depending on certain conditions, okay. So that's basically compensating balance. Also, we need to consider the maturity provisions, okay. Meaning, when you talk about maturity provisions, it basically talks about when you're going to pay for the principal amount of the loan, okay, how much is going to be paid in total, including all other fees and all other termination fees that needs to be paid, etc. Okay, so we talk about term loan, which is generally credit that is extended for 1 to 7 years in general, okay. This loan is usually repaid in monthly or quarterly installments, meaning there is an installment payment, okay. Please do not do not consider this term loan as the term loan similar in financial accounting because we use different terms. Okay? And this is only, by the way, term loan in the concept of financial management is only extended to superior credit applicants. Okay. And the interest rate fluctuates with market conditions, meaning term loans usually follow the prime rate or the LIBOR rate. Okay. So there, with that, we are now going to have another computation, which is going to be basically a computation of the cost of bank financing, meaning how much is the effective or how much is the real interest rate, okay, that is associated with our loan. So the effective interest on a loan is based on certain requirements such as or certain conditions such as the amount of the loan, the interest that you're going to pay, the length of the loan, the method of repayment, and whether the loan is discounted or not. Okay, when you say discounted loan, it means that the interest is going to be paid in advance when you receive the loan, or it is going to be deducted in advance from the total proceeds of your loan. Okay? So the computation for you to get the effective rate is going to be interest divided by the difference between the principal and interest multiplied by days, usually 360 days, divided by the days loan is outstanding. Okay, so that's the formula there. Okay. So let us have an example, assuming that there is a compensating balance here. Okay, so let us have the computation. So assuming that 6% is the annual rate, and the 20% compensating balance is required on the loan. So what will be the effective rate of the loan if there is a compensating balance? So the interest rate is only 6% based on what is written in the loan. But if you try to compute by simply following the formula interest divided by 1 minus the C or the compensating balance, then if you try to look at it, 6% divided by 1 minus 0.2, okay, or the 20% compensating balance, your effective rate is now 7.5%. Okay, so which means that you feel like you're only paying 6%, but in actuality you are actually paying 7.5% because of the compensating balance that will be retained in your bank account that you cannot use, okay, because it needs to be retained there as compensating balance. Okay, when dollar amounts or the peso amounts are used and the stated rate is not known, the computation will now be like this. Okay, the effective rate with compensating balance will be this particular formula. Okay, which is actually similar to what we have in the previous slide. This one. The only difference is now we have the compensating balance, so we need to consider it in the formula. So we are going to consider the compensating balance here. Okay. So that's basically for compensating balances. Okay. We now go to our installment loan. Okay. So because it is possible that the bank will charge us with a loan, or that's going to be paid on installment basis. So in this case, if you are going to compute for the effective rate of installment loan, then you're going to have this formula. That's going to be 2 times the annual number of payments times the interest divided by the total number of payments plus 1 multiplied by the principal. So this is just a formula that you follow. But basically, the purpose of this example is for us to know, particularly if you're going to borrow and the payment is installment, okay, it means that your effective interest rate is going to be higher as compared to what was or what is presented in you or presented to you in your in your contract of loan. Okay, so next we go to the annual percentage rate. We're going to skip this because this is actually a loan in the United States. Is not going to be affecting our business, okay, or our economy here in the Philippines. But basically, the concept there is if you are going to if you're going to borrow, or if you're going to borrow money, okay, it will require, okay, the use of the actuarial method of compound interest during computation, okay, which means that the lender must calculate interest for the period on the outstanding loan balance at the beginning of the period. So basically, you are just going to give the borrower an idea of how much is the real cost of interest and cost of payment. Okay, so that's going to be um, the concept there. And whatever is computed is going to be the basis of the amortization later on. Okay, so there, the amortization of your loan. Okay, so we have this what we call credit crunch phenomenon. So this is going to be also one concern later on if we're going to borrow funds, particularly if like in this situation right now that we are having, we are under a pandemic. There is actually going to be a credit crunch wherein there is going to be a tight money policy, okay, wherein companies or the government and other financial institutions must make sure that they are maximizing the use of their funds and not simply releasing money or extending loan to anyone, okay, because the economic condition is actually not that good, okay. So in a credit crunch, these are the usual conditions, okay, that we can see, okay. So first, there is unexpected defaults, meaning there will be bank customers, okay, that cannot pay the loan. There is economic recession, or there is a decline, or a steep decline in the performance of the economy. There is going to be a change in monetary policy, meaning there will be, just like what I said, a tight monetary policy, okay, and there will be other economic setbacks, okay. So initially, in a credit crunch, there will be a tight money policy there, but then later on, the government can extend a stimulus, okay, in order for the economy to recover, okay, meaning they are going to release funds to the market or to the public in order for the public to once again use it for the economy to once again run, okay. That's basically what's going to happen there, okay. So that's for loans. We are now going to have our commercial papers, okay. So commercial papers are short-term unsecured promissory notes issued to the public, okay. This can be in the form of finance paper or direct paper, dealer paper, which is going to be coming from banks or other underwriters, and then asset-backed commercial papers, which means that there is going to be collateral on the commercial paper, that or the notes or the payable, the promissory notes that you issue. Okay, so that's basically the concept there. Okay, in your commercial paper transactions, there is what we call book entry transactions, wherein there is a computerized handling of commercial paper, and there is no actual certificate that is created. Okay, so this is now the trend here. So basically, if you want to borrow funds through commercial paper, okay, then you can actually go to the bank, okay, and ask if they have what we call commercial papers for, or they have short-term borrowings there, or they offer short-term loans, okay. So that's basically the concept there. Of course, since this is short-term and this is unsecured, it is not generally given to anyone, okay, who is not creditworthy, okay. So this is an example of this is the graph of the types of commercial papers outstanding in the United States, okay. So the pink line is the financial, okay, the dotted blue line is the non-financial, and this is the asset-backed commercial papers, okay. So if you try to look at this, the asset-backed, okay, the asset-backed commercial papers is actually increasing, okay. The trend for the non-financial and financial commercial papers are What's this? This is basically a U shape. Okay? But if you try to look at this, during 2007, okay, commercial papers actually declined. Okay? Basically, 2007 onwards, there is a decline in your commercial papers. And this is actually when the recession happened in the United States due to the what you call this, there was a decline in the US market because of the hedging problems or the banking problems that happened due to the derivative scandals or the hedge fund scandals that happened in the United States. So that's what's happening here. That's why there is a decline. Okay. So anyway, this is just to give us an idea of how much funds are actually being generated or being issued, okay, with commercial papers. Okay. So what are the advantages of commercial papers? So with commercial papers, okay, you can commercial papers can actually be issued at below the prime interest rate. Of course, this is short term. So remember, if this is short term, the interest rate will usually be lower. Okay, but of course, you need to pay the debt on a shorter period of time. No associated compensating balance requirements, okay, because this is a short-term loan, so usually no compensating balance is required because compensating balance is generally for long-term loans only. And associated prestige for the firm to float their paper in an elite market. So if you want to raise money from commercial papers, okay, then you can actually create your own, okay, for as long as your business is actually a reputable business. Okay. However, there are also disadvantages of commercial papers. Okay. So the first is many lenders have become risk averse. Okay, post a multitude of bankruptcies. So usually lenders are hesitant to issue to either invest in commercial papers, okay, or to use commercial papers because basically this is going to result in higher risk because number one, it is short term, and number two, there are always defaults, okay, because there is no security or this is unsecured. Okay, next, firms with downgraded credit rating do not have access to this market because basically commercial paper is only available for those who has good credit rating. The funds generation associated with this is less predictable because you do not know how many will avail of your commercial paper, okay, etc., and all other conditions, and lacks a degree of commitment and loyalty associated with bank loans. Why? Because generally for commercial papers, okay, there is going to be as compared to bank loans where there is going to be more process and more credit check, etc. For commercial papers, there is no such thing, or there is going to be a lesser extent of that. So of course, there's going to be a lack of commitment in this particular types of financing. Okay, so with that, we can actually go to foreign borrowings also, but of course, it is not available to small firms that do not have international presence. So you can borrow money from foreign entities such as the euro-dollar market, etc. Okay, but again, this is only considered for multinational businesses who has access to the euro-dollar market. Okay, and of course, always remember that in your international borrowings or in your foreign borrowings, there will always be a risk associated with the differences in currencies, or there will be foreign exchange risks involved there. Okay, so there. So we now go to short-term financing that uses collateral. Okay, so you can also borrow funds, okay, on a short-term basis, but it needs to be collateralized, meaning you're going to provide a security or a collateral to your loan. Okay? So it is considered to be a secured credit arrangement when number one, credit rating of the borrower is too low, or there needs to be a secured credit arrangement Okay? When the borrower has a low credit rating, they need funds, okay, or they are requiring, or they are in need of a very high amount of funds, and the primary concern is whether the borrower can generate enough cash to liquidate the loan when due. Okay? So in order for the lenders to be sure that the loan extended to this particular borrower is going to be repaid, then they will require a collateral from the borrower. So this is going to lessen the risks involved in the borrowing. Okay? So there is what we call Uniform Commercial Code, okay, which standardizes and simplifies the procedure for establishing security against a particular loan. And usually banks will also apply this particular policy, not necessarily the same title or the same label, but banks actually use this particular process of requiring, okay, mortgages or requiring collaterals in the extension of loans, which is now called what we call mortgage. Okay. We can also use accounts receivable financing. This is another way for us to finance our business. Basically, what we try to do in accounts receivable financing is either we pledge, meaning we are going to use our receivables as collateral, or we are going to sell our receivables, and that is what is called factoring. Okay? So the advantage of accounts receivable financing is, number one, or basically it permits the borrower to borrow a certain amount that is tied with the level of your accounts receivable. So meaning, if let's say for example your receivable is 1 million, then you can basically borrow up to a maximum of 1 million depending on the quality of your receivables. Okay? Disadvantage, this is a relatively expensive method of acquiring funds, because in your pledging or in your factoring there is what we call service fee. Okay? That is going to be charged depending on the amount of receivables. So usually this is a percentage that is going to be deducted from the amount of your receivables. Okay? So with pledging, okay, basically the lender or the lending firm will decide on the receivables that it will use as collateral. So the lender will be the one to pick out which receivables will be used as collateral, and the loan percentage that will be forwarded or that will be extended to the borrower will depend on the financial strength of the business and the financial strength of both the business and the companies that are associated with the receivables, and then the creditworthiness of the owners of the receivables or the customers, okay, from which the receivables will be collected. Okay? The interest rate is well above the prime rate. Of course, that's going to be one disadvantage because it is going to be computed based on the balance outstanding. Okay. For factoring of receivables, basically this is what we call the outright sale of receivables. The factoring firm or the firm that will purchase the receivables usually do not have recourse against the seller. So meaning they cannot ask the differences, or whenever they incur losses from the sale transaction, they cannot recover it from us. But because of that, there will always be a service charge associated to the sale. Okay? The finance companies, okay, may do all or part of the credit analysis to ensure the quality of the accounts. So this is going to be one source of the service charge. And the factoring firm is also going to absorb the risk, okay, which is going to be another source of the fee. And there will be an advancing of funds to the seller. Okay? So that's basically going to be another source of fee, which is going to be the lending fee. So similarly, if to give us another example or to further explain, under the factoring of receivables, if let's say for example, you have 1 million worth of receivables, do not expect that you will also receive 1 million. because there will be deductions for fees and charges relating to the factoring. Okay. So an example is going to be like this. So if you have $100,000, okay, that will be processed at a 1% commission and a 12% borrowing rate. Okay, then the effective cost associated with the factoring will be 1% commission plus 1% interest per month, total of 2% fee monthly, multiplied by 12 months, then that's actually 24% annual rate. So expect that there will be fees associated or cost associated with the factoring of receivables. Okay? So the rate may be considered to be high, but of course, the risk associated with the receivables is also going to be removed from the seller of the receivables or from the company. That's why the interest rate is expected to be high. Okay? And it also allows the firm to pass on much of the credit check, okay, to the factor. So basically, the reason why there is a high interest rate or there is a high service charge for factoring is because you are basically passing or transferring all the risk associated with the collection of the receivables to the factor company or to the buying company. Okay? So this is another source of your financing. You can also enter into asset-backed public offering. Okay? So there is an increasing trend in the public offerings of security backed by receivables as collateral. Okay? The interest paid to the owners is tax-free. And the advantages to the firm are as follows: immediate cash flow, high credit rating, and it provides corporate liquidity and short-term financing. The disadvantage, however, is there is risk associated to the receivables that the receivables will actually be paid. Okay, so you can do this as another means for you to receive or to generate funds for your business. But of course, there will always be risk related to your public offering. I think this is not usually done in the Philippines. You can also use inventory financing. So this is similar to your receivable financing. So you're going to use your inventory as the collateral for your borrowings. So basically, if you are not able to pay, they will get your inventory. So that's going to be the item that will be applied to your payment. So the factors influencing the use of inventory will be the marketability of the pledged goods, associated price stability, perishability of the product, and the degree of physical control that the lender can exercise over the product. So basically, if your inventory is highly liquid, or it is durable, it is not perishable, it has a stable price, then usually you can have this as a good means for you to borrow funds or to generate financing from your or for your business. But depending on the quality of your inventory, then inventory financing may not be that advantageous to your business. Okay? So with that, we consider the stage of production. Okay? So the stages of production usually will involve raw materials in goods in process until finished goods. Your raw materials and finished goods can usually be your best collateral, and you cannot usually have your goods in process as your loan collateral because usually no business or no lending firm will allow goods in process as collateral because these are not yet finished goods or these are not yet finished products. So they can allow raw materials because anyway raw materials can be sold to other producers, and also of course finished goods are generally the items that are for sale, so they can use it as collateral or they can accept that as collateral, but there will be a little chance or a small chance that your lenders will allow goods in process to be collaterals. Okay. So with regards to nature of lender control, this is going to be, of course, if you are going to use your inventories as collateral, the lenders must need to make sure that they can control the inventories that you are going to pledge. Okay? So because it provides greater assurance to the lender, okay, but of course it will also result in higher administrative costs because they will be, or the lenders will be the one to manage or to hold the inventories here. So the types of arrangement involved in lender control will be number one, blanket inventory liens, okay, which means that generally there is a contract or there is a paper or a document that proves that the lender has a general claim against inventory. So this is just a paper, notarized, or a public document that gives the lender the general right over the inventories. Okay? There is also what we call trust receipts. Okay? Wherein there is a document or an instrument, okay, wherein before a sale happens, it must go through the lender, okay, so that the lender can monitor the movement of the inventory, okay. And there is also what we call warehousing, okay, wherein the goods in the warehouse of a particular borrower, okay, can only release or can only remove the goods from the warehouse upon the approval of the lender, okay. So this is, or this can be done either through public warehousing, meaning you are going to transfer the goods to a public warehouse that will only allow the movement of inventory upon the authorization of a lender, or field warehousing wherein there is going to be a person in charge of, a person assigned by the lender who is going to be in charge of the approvals of the movement. Okay. So, of course, we also need to consider that in inventory financing, that we need to appraise the value of the inventory, okay, because we need to know how much can we sell or how much can we get from the sale of these inventories later on, if this will be the payment that you're going to receive from the borrower, okay. So sorry, so with this, we need to consider that your appraisal will involve substantial administrative expenses because you are the one who's going to pay the appraisal cost. Okay, there will be an increase in the overall cost of borrowing, and there will be extension of funds that is well synchronized with the needs of the borrower. Okay, so that's basically for inventory financing. And then finally, we have the concept of hedging to reduce borrowing risk. Okay, so basically, what you're going to do is to hedge, okay? Or basically, you are going to use an instrument or another contract that will try to offset the risk that is associated with the borrowings. Okay? So, basically, hedging is engaging in a transaction that partially or fully reduces the prior risk exposure that you have, and this is going to be attained through the use of various derivative contracts, okay. Usually this is going to be through future or forward markets, okay. But then of course, like in the Philippines, you cannot actually do this because there are no futures or forward markets in the Philippines, okay. So what you simply do is to trade your financial instrument. And by the way, just to give an idea, this is the reason why there was a problem with the economy of the United States in 2007, because they overused the use of futures market or the derivative market. Okay. So basically, this is an example. So if we are going to, let's say, we're going to extend credit, okay, and we are going to invest in a hedging instrument in order for us to offset the risk associated with the loan that we extended to a particular business. So if the price, okay, if the sales price of the bond, okay, is 100,000, and the price of the bond, okay, that we traded it for is actually 95, then later on there will be a profit of 5,000. But of course, we cannot determine this because just like what we said, the performance of the derivative contract or the hedge contract will be dependent on the kind of futures contract or the futures market that you're going to enter into. Okay? There. So, also you can enter into hedging by entering into an interest rate swap. Okay? Meaning you are going to enter into another contract with another party that's going to be allowing you to swap interest rates between the two of you. Okay? So if you want to have a fixed interest rate, then what you're going to do is to look for another market or another party that can or that is willing to exchange interest rates with you. So that's basically what's going to happen there. Okay? So that's with hedging. Okay? So that's basically how hedging works. But of course, again, hedging must be done or must be used in such a way that you are not going to use it for speculation purposes, because if you're only going to do that for speculation, then it is actually going to increase or to add up to your risk instead of removing or reducing the risks associated. So that's basically how we do hedging. Okay, so that's the end of our discussion. Okay, and this will be the last topic before we have the exam. Okay, so thank you.